Philippine real estate didn't recover this year. It's split into two completely different markets, and most people are still analyzing just one of them. Here's what's in this video: five real estate stocks with real numbers, one trading at three times earnings, a REIT that's paying you less than a government bond to take on property risk, and I'll show you exactly which one. And then there's that often cited phrase, Pax Silica, that could, if done right, quietly reshape an entire province north of Manila. A year ago, I called this market, a mid-reset. Oversupplied in the towers, undersupplied in the suburbs. That framework's actually held up, but it didn't finish. Let's see where it actually stands right now. Now, quick thing before we get into it: if you want these breakdowns, just like this one, real numbers, not the headlines, follow along or subscribe so you don't miss the next one. One half of this property market produces income. The other half produces hope. One half sits on land that's genuinely scarce. The other sits on land that only looked scarce because no one had built next door yet. That's the real divide in Philippine real estate right now. And once you see it, you can't unsee it in every stock, every REIT, every for sale sign that you pass. I use a five-question test to sort the winners from the losers. It's called BEARS. How hard it is to build competing supply? Can you actually get land and materials? Does the regulatory setup help or hurt you? Is real demand growing or just coasting on old momentum? And can the owner charge a premium or are they stuck competing on price? Run every property type through that, and the picture gets uncomfortably clear. Let's start with the part no one's surprised by. Metro Manila has somewhere between 80,000 and 83,000 unsold condo units right now. Completely separate research firms counted this independently and landed in the same neighborhood. So that's not noise, it's real. Vacancy is projected to hit 26% by year end, and developers have noticed. New launches the first half of this year down 64% compared to last year. But here's a twist: demand didn't really vanish, it just moved downstream or down market. Units priced between 1.8 and 3.6 million pesos more than doubled their share of total sales this year. And about 2 hours outside Metro Manila, Cavite, Laguna, Batangas, Pampanga, and Bulacan, house and lot take-up is running 80 to 96%. So same country, same asset class roughly, completely different market. There's also warehouse boom. South of Manila, in what everyone calls CALABA, Cavite, Laguna, Batangas, warehouse and factory rents are at their highest in the entire country. Laguna's running about 284 pesos per square meter. Compare that to Bulacan at 194 per square meter. Real tenants are behind those numbers. The US chip company bought 60,000 square meters in Calamba this year. Land in Calaba is genuinely running out, so developers are pushing north instead into Pampanga, Tarlac, Bulacan, where a wave of new industrial supply, roughly 870 hectares of it, is coming online through 2028. That's a lot of new space landing fast and worth watching whether tenants show up on the same schedule. Now, about Pax Silica. In April, the Philippines joined this US-led coalition securing semiconductor and critical mineral supply chains. 13th member in it. The proposed site sits inside a 4,000-acre economic zone at New Clark City in the exact same central zone corridor, already soaking up new industrial land. The number being noted is $40 to $7 billion in eventual investment and over 130,000 jobs. Now, none of that is committed money. First phase construction is still 3 to 5 years from breaking ground. Treat it exactly like every government mega project. A real tailwind for land values, even if a piece of that lands on schedule, and a rounding error if it doesn't. Worth watching closely, not worth betting the farm on today. Okay, here's the part you actually clicked for. Five names, quick real hits, real multiples. Ayala Land. First half profit fell 19%, but its leasing and hospitality grew 9%, and the company is shifting hard toward recurring income. Trades at about five times earnings. It's cheap if that shift actually lands. Then, of course, there's SM Prime. Revenue up 5%, rental income now makes up 61% of total business. It trades at about 11 times earnings, a real premium, but it's the most established recurring income name on this list. We also have Robinson's Land, revenue up 10%, profit up 12%, low debt per developer, around six times earnings, with a 5.7% dividend yield, growth, income, and a clean balance sheet all into one. Mega World, pre-sales up 15%. Provincial demand is doing very well. Horizontal market player outperforming right now. 3.3 times earnings, so one of the cheapest names on the list. Then there's Philinvest Land, a bond raise that got oversubscribed three times over, improving numbers, trading at around 3.8 times earnings. This is the one where I think operations and valuation generally haven't caught up with each other yet. So five names, five different bets on where this split actually resolves. Now, here's the part that actually surprised me about this, and it's the reason I said suspense earlier, because this completely inverts what most people assume about REITs. A REIT lets you own a slice of the income producing property without buying the building yourself. By law, they have to pay out at least 90% of distributable income as dividends. So, sounds simple. Check the yield, buy the highest one, done. Here's the number that may stop you. The Philippine 10-year government bond was yielding roughly 7.3% in mid-August. A REIT, the Yalo REIT backed one, was yielding 6.7%, while Robinson's REIT was yielding 6.1%. Read that again. You can buy a government bond, zero property risk, zero vacancy risk, zero tenant risk, and earn more than what the two of the three major REITs are paying you to take on all of that risk. Only M-REIT MegaWorld REIT cleared the bond at 7.7%, and that's a modest spread once you actually think about the risk you're taking on. This isn't a knock on REITs as a structure. It's a reminder that dividend yield means nothing in isolation. The real question was never which REIT pays the most. It's, am I actually getting paid enough to hold property risk when a government bond is sitting right there paying almost the same for none of the risk? Now let's look at the macro backdrop. So just a quick gut check on the wider economy because it matters. GDP growth slowed to 2.3% last quarter, down from 2.8% in the quarter before. Household spending barely grew. Capital formation actually fell over 9%. And the rate cuts that were supposed to make mortgages and financing easier, they haven't happened. The central bank's actually been raising rates this year, not cutting them. A year ago, part of my framework assumed cheaper borrowing would eventually help this market breathe. That assumption hasn't paid off yet. Higher borrowing costs remain and a real headwind, especially for anything that depends on affordability rather than genuine scarcity or income. So here's where this actually lands. The segments doing better right now all share the same three things: recurring cash flow, land that's genuinely hard to replicate, and real economic demand behind it. Not a resale story waiting for a future buyer to show up. That's your horizontal housing, your CALABA warehouses, your better positioned REITs. The segments still stuck share the exact opposite. Oversupply, a resale thesis doing too much of the heavy lifting, and the dependence on rate cuts that haven't really arrived. So if you're buying stocks, that split shows up directly in the five names I just walked through. And now you know exactly what to look for in each one. If you actually own property, or you're thinking about buying, the same five questions apply to your specific unit, your specific submarket, not the headline. Nobody gets to call this adjustment finished. But for the first time in a while, you can actually see which half of this market is doing the adjusting the hard way and which other half is quietly doing just fine. Full written breakdown, every number, every source is linked below. And if you want a stock or a REIT run through this exact same process, drop it in the comments. Um, one thing, one more thing. Pax Silica is the loose theme in this entire story. Still years from breaking ground. Still could go either way. I'm tracking it closely. Subscribe or follow along so that update lands in front of you the moment it happens, not months later. This is June on investing. Stay integrated, stay curious, stay ahead.